Hello friends, in this session we will talk about two important topics of current issues section. The first topic is beyond Libor and second topic is replacing Libor. Both the topics are about transition of Libor. So very soon, we all know, very soon the Libor will be abandoned and we will enter into a new era where we will have the SOFR or SONIA as a risk-free rate benchmarks, right? So this discussion is about this particular transition. So what is going on in this transition? What are the problems with this particular transition or with this particular transition phase and so on? So this is a primary discussion of both the topics. So that's why I'm combining both the topics, right? If you want to understand these two topics in detail, my recommendation is I have uploaded the video called Libor Scandal for FRM and CFA on YouTube. I will link that particular video in the description of this video. So watch that video first. The video is very short, 8-minute video. And once you understand that particular video, that is, you need to first understand why Libor is getting abandoned. So to understand that, you need to understand what was the Libor scandal. So once you understand the Libor scandal and the reason for abandonment of the Libor scandal or Libor, then only you will be able to understand these two topics in detail. This discussion is also very short and sweet, very limited discussion. You don't have to worry about the other part. So we will cover only the important points and testable, highly testable points in the session. Okay. So you can pause this video, watch the Libor scandal video, and then come back and start from here. Now, in the Libor scandal video, we discussed about what was the scandal, the history of Libor. Then we talked about the ICE is going to abandon this Libor. Okay. So in that video, I guess I forgot to mention that why ICE is abandoning the Libor, right? So see, we all know that from BBA to ICE, there was a transition. Okay. So there was a transfer of Libor's administration from BBA to ICE, right? So in that transition, they changed the calculation methodology. So Libor was improved, definitely improved compared to the previous calculations, which were done by the BBA, right? Here, even after calculations, even after the new calculations, new methodology of calculation for the Libor, we are still abandoning, or ICE is still abandoning the Libor, right? So what is the reason for this? So reason was very simple. ICE is saying that a lot of institutions are resisting the use of Libor. They are not very comfortable with using the Libor because the reason is very simple, because of the Libor scandal and is subject to manipulation. So ICE is saying there is not much space left to improve the Libor. Now it is best to change the Libor, right? So change the benchmark. So Libor to SOFR or Libor to SONIA, right? Again, if you are not able to understand what is SONIA and SOFR, watch the video, the Libor scandal video, where we discussed the SONIA and SOFR also. Okay, so first topic is the Beyond Libor, a primer on the new benchmark rates. Now, these papers are old papers. These are not written in 2021. So you will find a lot of obsolete information here. So I will update you on that. Okay, so I will give you the new changes which are currently going on. And my guess is, if GAP asks you the question, the GAP might expect you to know the new information, right? So let's start with the features of comparing the ideal benchmark. Now here, okay, so this particular point is fine, that ICE is saying abandon Libor. So ICE is saying that they will stop publishing, it will stop publishing the Libor by 2020 to 2023, right? So, okay, they'll stop publishing, fine, no problem with that. But what will happen with the new, or how to choose the new benchmark, right? So this was a discussion in 2017, 2016, not in 2021. So from the 2017's perspective, so what are the features of good benchmark rate or ideal benchmark rate, which is capable of replacing the Libor? So we have three primary characteristics of the a benchmark rate. So first, I will just quickly read it out and then I will give you the explanation of these key points. In the Libor post-scandal period, new rates are being considered. Again, assume you are in 2017, not in 2021. Are being considered to replace the Libor. Okay, so why I'm saying this, assume you are in the 2017, because this paper was written in around 2018 and so on. We are in 2021, we have a certainty about use of SOFR. SOFR is now finalized and SOFR is going to replace the Libor. That's sure. USD Libor. okay, to be specific, and GBP LIBOR will be replaced by SONIA. Now here, rates under consideration should have some features of an ideal reference rate. So following are those features. So what are the features of ideal reference rate? So this is a testable point. First is, it should be derived from the actual transaction data from the liquid market. So what is the problem with the LIBOR? So LIBOR was not based on the actual transactions. It was a survey based rate. So the ideal, like the good features, so the features of ideal benchmark rates is, first feature is it should be based on the actual transaction rate. Then able to offer reference rate for financial contracts outside money market, because see, these rates will be derived in the money market. Even if you take the treasury rates, so these are the money market rates, right? LIBOR, again assuming the money market as in the borrow and lending, that particular process, it is derived from that process, but we have remaining financial market which relies on this particular rate. So the rate should be in a way that the whole market or the remaining market should be able to rely on that. Okay, so it should be able to offer reference rate for financial contracts outside the money market, and should be able to construct a term structure. Very important point. Term structure as in, for LIBOR, we know we have the rate, like if you go back to like say 2012, okay, before LIBOR scandal, we had rates starting from, there are total 15 rates. So for every month there were rates, LIBOR rates, and again we had remaining like weekly, monthly and 15-day rate, like that. So with the help of LIBOR, we were able to construct a term structure. So we are saying here, the author is saying that the ideal benchmark rate should be such, it should be able to, like we should be able to, we as in as a risk manager or like the traders and so on, should be able to construct a term structure. Then able to serve as a term lending and funding benchmark. Okay, so these are the 3 points. So first point is very important. This is mainly for the wholesale funding. Okay, so this rate should be based on the wholesale funding. This is the point here. Meaning, so you should be able to apply this particular rate for a big chunk of borrowing or lending, right? So for small portion, if someone says that it is, I am fine with 1% rate, it is like, there is no logic in that, right? So say for $100 or $200, there is no logic if someone is quoting that, okay, I'm ready to, assume the big banks, if they are saying like, okay, I'm ready to borrow $200 at 1%, then there is no logic. So this should be a wholesale rate. Okay. Now next, issues that led to replacement of LIBOR as a reference rate. So in this particular part, to skip this part, you need to first again watch the scandal video, LIBOR scandal video, and here I will quickly read it out. I have nothing to explain here because everything is already explained in the previous discussion, that video. So LIBOR, before LIBOR, treasury bills for the US dollar specifically were used as a reference rates. Using a treasury note for asset liability management generates a basis risk for the banks. Why? Because see, bank is working in the actual environment, right? So if the risk increases, if the market liquidity drops or general risk increases, automatically there will be fluctuation in banks borrowing and lending rates, right? But if the bank is using the treasury rate as a reference rate for the calculation, treasury rate is not going to move according to the market. It is stable, right? So that's why it creates a basis risk. Like banks or actual funding borrowing rates will change, but again, treasury rate, the reference rate which you are using for say hedging purpose, it is not going to change. So this was the reason, this is the problem with the treasury rate. That's why LIBOR came into picture, and hence fails to meet the third condition mentioned. Yeah, sorry. So treasury rates didn't move with the respect to market condition, and hence fails to meet the condition mentioned above, third condition mentioned above. Eurodollar LIBOR was better compared to treasury rates. Eurodollar LIBOR as in the LIBOR rate constructed in the London market or that zone. Okay, I will upload separate video on the Eurodollar LIBOR. Okay, so this is a very separate discussion, like what is the Eurodollar LIBOR. If I have to give this short introduction or short information about the Eurodollar LIBOR. So the concept of Eurodollar LIBOR was very simple, or is very simple. After World War II, this is USA, this is rest of the world. Okay, fine. So after World War II, there were two reasons because of which the dollar got outside the US, and they are hold this particular currency is in the is in hold with the other banks or other countries. Okay, so other countries having USD. Fine. So first reason was the Marshall Plan. So Marshall Plan is nothing but the plan after this particular World War II. A lot of countries were facing distress. So to help them, to give them the financial support, USA transferred some dollars to these particular countries. So say rest of the world. Okay. So this is the one way because of which the dollar got out of the country, USD zone. Okay. And then second was because the dollar was relatively safer. So a lot of countries started buying Libor, okay, buying USD. Okay. So they were holding the USD. They were holding large chunks of USD. Now, this particular portion of USD is still in the market and outside the USA. Remember this. This is outside USA. So whatever the portion of USD dollars is outside the USA is known or is called as the euro dollar. Because most of the countries were the European countries which were holding the dollars. So that's why we call this particular dollar. It is not different dollar, but the dollar which is outside the USA, this dollar is called as the euro dollar. Now, why euro dollars lending and buying rate is important? So the rates, the Libor, so if you think about it, so Libor is derived in London, right? So USD Libor is derived in London as well, right? So in London, there are the big banks and all these banks are holding the USD. So if they have the exposure to USD, even in USA, if they are holding USD outside USA, still they are covered, right? So they have their position covered. So that's why all the all the lending and borrowing rates of the USD outside the USD, that is for the euro dollar, that those rates are applicable for the USD as well. Not regulatory applicable, like not legally applicable, but this is how the market works. This is in the synchronization. So if the borrowing and the lending rates in the euro dollar are say 2%, then automatically same rate will be applicable for the USD, which is in the USA. So this is the euro dollar concept. And here we mean the discussion is like this particular euro dollar was better compared to the treasury rate, meaning the rates were derived in that eurozone. Again, this is not limited to euro. It can be Asian countries or rest of the world. Okay, so every time you read the euro dollar, just imagine rest of the world. So Libor was better compared to the treasury rates in this manner, which led to replacement of T-bills rate. Now the Libor comes into the picture. Again, we are going 30-40 years back. The major problem with the Libor is it uses survey data instead of transaction based and hence subject to manipulation. Following are the reasons which are pushing for the Libor replacement. The first reason is that the rates are not based on the actual transaction and subject to manipulation. First reason. Interbank deposit markets are less active now. Now, this particular Libor was derived by the interbank, right? So Libor stands for London Interbank Offered Rate, right? So interbank, as in all those big banks, creates an interbank market, and this particular, like, they lend and borrow to cover their position, cover their liquidity position. So all these big banks previously used to transfer funds immediately, so that they are covered. Okay, so sometimes say bank A is facing some type of liquidity problem, so it will borrow it from the other banks, and next day say the bank B is facing the problem, then it will return and then it will lend and so on. This is how the market works, right? This becomes less active because of the excess liquidity funded by the government, central banks. Okay, so because of this, because the central banks are now providing the liquidity, there are different windows for the borrowing and all. So because of this particular reason, interbank lending and borrowing market is now less active. Then third is the increased fluctuation in credit risk of individuals since 2007. This makes LIBOR-based benchmark ineffective, which tries to capture average bank credit risk exposure. Fine, like this again, the basic point. There is if see, LIBOR is about the risk-free rate. It is considered as a risk-free rate, obviously the benchmark rate, but again the interbank rate, right? So this is the interbank rate and risk-free rate. But in real life or in real market, the credit risk is fluctuating more, and LIBOR is not able to compensate that or support that. We will have this particular parts discussion in detail in one particular chapter where we have when selling becomes disruptive. Okay, so we have topic on in how COVID period, like in the COVID period, how selling becomes very active. Okay, so in that part again I will elaborate this particular part. Next is banks rely more on less risky wholesale non-bank funding repos. Non-bank funding as in from the insurance companies and so on. So LIBOR is interbank, but bank's preference is non-bank, like the insurance companies, pension funds, and so on for the borrowing purpose. So that's for this particular reason. Again, this rates, the foundation of this rate is not very applicable or not very good for the current market. Now, International Organization of Securities Commission, IOSCO, published a recommendation for reformation post-LIBOR scandal. The principle developed in this paper are, so this is the paper, post-LIBOR paper, post-LIBOR scandal. This is the paper. It gives three important aspects or three important key points which you need to consider. The interest rate benchmark should be derived from the actual transaction, that is the transaction data in the liquid market. The governance arrangements for the benchmark administrator. So you have to provide a governance arrangement. So how this particular benchmark will be governed. And then use of most liquid sections of the money market. Okay, so these are the three recommendations. So if you get a question in the exam, like as per the International Organizations of Securities Commissions, what are the three recommendations? Always remember, these are the three recommendations. Don't by mistake, even by mistake, take, like say LIBOR is subject to manipulation. It is correct point, but not from the IOSCO. Okay, no, not from the IOSCO's suggestions. So this is the point you need to remember. Then next, specific recommendations from IOSCO and FSB are to establish a new reference rate that incorporate the following features. Short-term transaction based overnight reference rate, RFR, that have large trading volumes. So you have to choose the short tenor, that is short-term rate, and it should be overnight reference rate. Okay. Then including non-bank wholesale counterparty and not just relying on IBOR. IBOR is interbank offered rate. So in India we have MIBOR, Mumbai Interbank Offered Rate. We have TIBOR. Okay, so Tokyo Interbank Offered Rate, or TOBORs, something like that. Determined by the secured transaction rather than using the transactions for the same jurisdictions. Okay, now all of these features, the features which I mentioned above, all of these features may not be currently possible. It is not currently possible in just one benchmark. So overnight reference rate are the transaction based, but do not provide desired hedging feature needed by the banks, like the unsecured term beyond the overnight. Again, the basic point here is the key point which you need to remember or know. So there are three principles based on which the software was derived. So what are the fundamental principles or the basis or the key principles? First, the rate. Again, in 2017, take back yourself in 2017 and now think. In 2017, the thing was you need to have three properties in the particular benchmark rate. So firstly, it should be based on the transaction, collateralized, and wholesale. Fine, so that it becomes a risk-free rate. So ONIA, Old SONIA, EFFR, then OBFR. These rates are not for the wholesale and not collateralized, not applicable in this particular part, but these are transaction based. Okay, so these are the rates which are transaction based. Then you have, this is the old SONIA. Okay, so if I'm talking about the SONIA, I'm talking about the new SONIA, this particular SONIA, not old SONIA. This particular SONIA, which is again, which is going to, this SONIA will replace GBP LIBOR. This particular SONIA is wholesale and transaction based. But we also have TONA, Easter. So we have different again benchmark rates. Here we have two more rates, but major like emphasis is given on the SOFR. SOFR is following or fulfilling all three properties. It is collateralized, it is wholesale, it is transaction based. Remember, old SONIA is transaction based, but do not follow all the remaining like other properties. New SONIA is wholesale and transaction based. This is the key point. You need to remember this. Okay, and the same, this is the table from the paper, the same paper, and everything is explained in a tabular format. So same diagram is explained in tabular format. Just read it out. You will understand it. Okay. Now next, the trading volumes are much higher for old reference rate compared to the SOFR plus SONIA. If you combine both SOFR plus SONIA, still trading volumes for LIBOR are very high, but LIBOR and the SOFR and SONIA are picking up. Okay, so new reference rate are more likely to move outside the target ranges set by the central banks because non-banks have no access to central bank reserve. The volatility is a key point. Volatility in SOFR market reflects the condition in the collateral market and dealer balance sheet window dressing. Now this particular part, my recommendation is remember this particular point. It is not possible to explain the window dressing part in very short discussion, because window dressing is about like on the last day of the transaction settlement of the month. In that particular period, there are the fluctuations, okay, in the different rates because of the transaction settling and so on. So this is a concept should be discussed in separate video. So I will discuss in separate video. So for now, just remember, volatility in SOFR market reflects the condition in collateral market and dealer balance sheet window dressing. Okay, treasury rate do not address this window dressing particular part. This is about the first topic, beyond LIBOR. Next topic is the replacing LIBOR. Now, the key issues that could cause systemic disruptions when LIBOR ends. Again, I'll start reading, and wherever there is anything to explain, I will explain. So LIBOR is most likely to be discontinued by the 2021-2022 in the phased manner. That is, first two rates will be discontinued and then remaining rates will be discontinued. LIBOR is currently active and used for the contracts with a notional value of $400 trillion as of 2018. This paper was written in 2019. SOFR is the most likely to replace. Now it is certain that SOFR will replace the LIBOR, but it has yet to gain the widespread use. Concerns with this discontinuance is that some legacy LIBOR contract don't have any fallback provision. This is a very important point. So what is a fallback provision? Now just imagine a situation where you have forward rate agreement of say for 10 years, and in that forward rate agreement, or just take the swaps example for the easy understanding, you have the swaps agreement and swaps floating rate is LIBOR plus 1%, and your swap is set 10-year swap, and this obviously starting in 2021 it will end in 2031, right? Now if the LIBOR is abandoned by 2022, say, so if the LIBOR is abandoned, what will happen to those contracts or the swaps which are based on the LIBOR, right? Now this is the problem. And even if say in SOFR and LIBOR, even there is a small difference, still this particular difference is problematic. This will create a big loss or profit for the entities who are having the position. Fine. Now here, the basic thing to understand is the fallback provision tells, like in case of this currently, okay, I'll explain. So fallback provision tells, like in case of LIBOR is abandoned, what we will do. like how to consider this offer into consideration, how to consider this offer for this particular contract. So there are no provisions for these particular contracts. So there are the legacy LIBOR contracts where you don't have any fallback provision. That is in case of the LIBOR's replacement, because there was no such thing as LIBOR replacement. No one imagined that LIBOR will be replaced. I personally think like it will not. Okay. So there were no fallback provisions. Now the thing is, what about the fallback provision? I hope you understood the fallback provision. In this paper, we will study that currently we don't have any fallback provision because it is written in 2019. In 2021, we have fallback provisions. Okay, so draft or the base draft for the fallback provision. So what will be the language, how it will be written, okay, how to mention the fallback provision. Everything should be like, you have to consider a lot of aspects, the legal aspect, the practical aspects, and so on, right? So it's not just like one man's job. So legacy LIBOR contract don't have any fallback provision and likely to see decline in the value due to LIBOR discontinuance. This could add distress to the market, of course, and lead to drying up of available credit to borrowers. The other part of LIBOR discontinuance, or the other problem with the LIBOR discontinuance, is problem due to uncertainty in whether the appropriate alternative to LIBOR will exist that permit the financial institution to be funded in the liquid market. Okay, so again, this is the second problem. So you have to remember two problems. Okay. So it is about the appropriate alternative again, because written in the 2019 or 2020. Now, some LIBOR contracts are extended beyond the 2025 and the institutions are still creating a LIBOR contract in the hope that LIBOR will continue for more time than expected. ISDA, here you have to focus. As per the paper, as per your curriculum, ISDA is currently working on the fallback language that could be relied upon as per the paper. Currently, standing today when I'm delivering this lecture, ISDA already provided the fallback provisions and all the caveats relating to the fallback provision. But for the exam purpose, just remember, ISDA is working currently, and ARRC, Alternative Committee on the Alternative Reference Rate Committee, has provided a guidance on fallback language, like how it should be. Okay, SOFR is identified and promoted as successor to LIBOR. Current state of transition and challenges that lie ahead. SOFR satisfied the requirement of having a market depth in the liquid market. SOFR growing strongly in the bonds and SOFR futures, but still lags significantly behind the LIBOR. Overall transition from the LIBOR to SOFR is slow due to legacy of LIBOR, that is 30 years old LIBOR versus very new SOFR, which is not tried and tested yet to that extent. Legacy of LIBOR and transaction cost of switching. Also, reasons like USD LIBOR provides 10 maturities compared to 1 in SOFR. LIBOR accounts for funding risk and SOFR do not, and some believe LIBOR will continue making SOFR adoption slower. Okay. Unsecured funding exists despite decline. Unsecured funding as in, see, LIBOR is based on unsecured, right? So because unsecured funding exists, so LIBOR is considered, that is LIBOR plus then risk premium is added there. So unsecured funding exists, and this is again the challenge which is there in replacement of LIBOR. Funding risk requires hedging. Large financial models, large financial institutions could use model, and this could add like, okay, so there is completely statement problem here. So I will give you the statements idea. So large institutions can come up with their own model and they can create a premium add-on on SOFR so that they can compensate for the LIBOR's replacement, right? And this is for the large financial institutions. Okay, and then they can use the SOFR for hedging, while the smaller ones could use the market-based rate. Okay, a Maribor is the market-based rate. So that can be used. Then government institutions' role in the transition. Authorities continuously providing a strong warning regarding the risk of reliance on the LIBOR. The change that can accelerate if there is more evidence that LIBOR will be terminated. So I said it will stop, it will abandon it by 2022. So now we have more evidence. Regulators need to make sure the financial institutions are ready for transition. So regulators also need to provide assurance to the entities that once the LIBOR based contracts are obsolete, they won't face any substantial losses. Individuals and small businesses are likely to hold loans that are based on the LIBOR, so the government ensures that the public has clear understanding of pending changes. Okay, so say some education loans and car loans are based on LIBOR. So what will happen after the LIBOR is replaced by SOFR? Will they get a new rate? And there are a lot of things, right? Phasing out of LIBOR is an extraordinarily complex problem. Time is running out and lots of work still need to be done to fend off the significant risk of major disruptions to the financial market. Okay, so this is about the replacing the LIBOR. Then we have the, okay, replacing the LIBOR, reading number 10. So these are your two readings. Okay, so that's all about the LIBOR section of your current issues section. In the next section, we will talk about the COVID area. Okay, in the class number 3, we will talk about the COVID or the climate risk. Fine. Okay, so bye bye, take care.